Okay, so today we're going to break down a framework that's, it's not just for finance wizards. It's for literally anyone who wants to make smarter decisions. We're talking about the fundamental ideas of risk and return and how you can actually use them in your career and in your life. I mean, think about it. Whether you're choosing a new project at work or maybe investing in a new training program for your team, or heck, even deciding on a career path, it almost always feels like you're placing a bet on a future you can't quite see, right? You weigh the pros and cons, but there's always that little bit of chance involved. And you know what? You're not wrong to feel that way. But here's the good news. While we can't just get rid of uncertainty completely, we can understand it, we can measure it, and we can manage it. There's a method to the madness, a way to play the game with a clear strategy, and it all starts with one core idea. Yeah, it really all boils down to a single, really powerful trade-off that basically governs every single decision that involves any kind of risk. This is it, the risk-return trade-off. And the principle is actually pretty simple. If you want the chance for a bigger reward, you have to accept a bigger risk. Think of it like this. Sticking with your old reliable software, that's the safe path, sure. But its potential for improvement, its return, is also pretty low. Now, investing in a brand new HR system, that could totally revolutionize your efficiency, a huge potential return, but it also comes with the risk that it might just fail. The bottom line is this: more reward requires more calculated risk. So, if every decision is a trade-off, how do we actually analyze it? Well, we need some tools. We need a way to measure both the potential upside and the potential downside. First up, let's look at the prize. The expected return is really just a clear way of defining your goal. It's the average outcome you're hoping for if you were to make this same decision a bunch of times. You can think of it as the why behind what you're doing. So here's how this makes it real. Instead of just saying, yeah, we hope this training helps, you actually quantify it. Your expected return is a 10% boost in productivity. See? Now you have a clear, measurable target for your investment. But what about the risk? How do we measure that? Well, that's where standard deviation comes in. I know it sounds technical, but trust me, it's just a number that tells you how wild the ride might be. A low standard deviation means the actual outcome will probably be very close to your 10% expectation. But a high number, that means the result could be much better or much, much worse. It's basically just a measure of uncertainty. Okay, so now that we know how to measure risk, what's the single most powerful strategy to manage it? Well, it all comes down to avoiding a really common mistake. Come on, we've all heard this, right? It's simple, timeless advice. And it is the core principle behind the strategy we call diversification. And in the real world, it looks something like this. Instead of betting your entire training budget on just one program, you diversify. You spread it out. You invest in technical skills and leadership and communication workshops. By spreading your risk, even if the leadership program takes a while to show results, that immediate boost you get from the other training can carry the team forward. You're just not relying on a single thing for success. But here's where it gets a little more nuanced. Diversification is incredibly powerful, but it doesn't work on every single type of risk. You've got to know what you're up against. So risk really comes in two flavors. First, you've got unsystematic risk. This is stuff that's specific to your company, like, say, poor leadership that's causing high turnover. You can actually control this and fix it with smart management. Then there's systematic risk. This is the big picture stuff. An economic recession, a major shift in interest rates. It affects everybody, and you can't just diversify it away. The key is knowing which kind you're dealing with. So, after all that, what's the game plan? Let's boil all this down into a clear playbook you can start using right away. It really just boils down to this. First, always see the balance, that trade-off between risk and reward. Second, try to put a number on both the upside and the uncertainty. Third, use diversification as your go-to tool against those uncontrollable risks. And finally, and this is a big one, recognize what's in your control and what isn't, so you can focus your energy where it actually matters most. And that brings us to the final thought I want to leave you with. This whole framework isn't just for business decisions. Think about your own life, your career, your skills, your personal projects. Where are you putting all your eggs in one basket? Leaving yourself a little too exposed to a single point of failure. Just asking that question, that's the first step toward building a more resilient and a more rewarding future.